The Great Depression causes, events, and aftermath. The Roaring Twenties was a decade of prosperity and growth. The stock market soared, and investors were confident that the good times would never end. But beneath this facade of economic boom were cracks that would eventually lead to the most devastating market crash in history. Several factors contributed to the 1929 stock market crash. Firstly, there was rampant speculation. Investors were buying stocks on margin, meaning they borrowed money to purchase more shares than they could afford. This led to inflated stock prices and an unsustainable market bubble. Secondly, there was a lack of regulation. The stock market was relatively new, and there were few rules to prevent excessive risk-taking and market manipulation. Lastly, economic weaknesses such as declining agricultural prices, overproduction, and uneven wealth distribution made the economy vulnerable. These issues created a fragile economic foundation that could not support the inflated market. The crash began on October 24, 1929, known as Black Thursday, when the market lost 11% of its value at the opening bell. Panic set in, and by October 29th, Black Tuesday, the market had fallen another 12%. Investors scrambled to sell their shares, but there were few buyers. Over the following weeks, the market continued to decline, ultimately losing nearly 90% of its value by 1932. The impact was catastrophic, wiping out millions of investors and triggering a chain reaction of economic failures. The aftermath of the crash was devastating. Banks failed, businesses closed, and unemployment soared to 25%. The economy entered a severe depression, lasting over a decade and affecting economies worldwide. The Great Depression led to significant changes in the financial world. The US government implemented reforms to prevent future crashes, including the creation of the Securities and Exchange Commission and the introduction of the Glass-Steagall Act to separate commercial and investment banking. Recovery began in the late 1930s, spurred by President Franklin D. Roosevelt's New Deal programs, which aimed to provide relief, recovery, and reform. These initiatives helped stabilize the economy and restore confidence. The stock market gradually recovered, but it wasn't until the 1950s that it regained its pre-crash levels. The lessons learned from the Great Depression shaped economic policies and financial regulations for decades to come. The Great Depression serves as a stark reminder of the dangers of speculative bubbles and the importance of economic regulation. By studying these historical events, we can better understand the complexities of our financial system and strive to prevent similar catastrophes in the future. Thank you for watching. If you found this video informative, please like, comment, and subscribe for more deep dives into financial history.